Did you know that the UK's economic trajectory in 2026 is being defined by a precarious balance between stabilising inflation and stagnant productivity? As of today, Tuesday the 23rd of June, we are seeing a critical juncture where the Bank of England's efforts to curb price volatility are finally meeting the reality of consumer spending power. While we've moved past the hyperinflationary shocks of previous years, the sticky nature of service sector inflation continues to put pressure on the average household budget. Today, we aren't just looking at numbers on a spreadsheet, we are analysing how the current fiscal environment is fundamentally reshaping the social fabric of British society, from the housing market to the accessibility of essential services. The Bank of England's Monetary Policy Committee has been under immense scrutiny this quarter. With the official bank rate currently hovering in a range designed to keep inflation near the 2% target, the impact on mortgage holders is profound. For those on variable rate deals, the cost of borrowing remains significantly higher than the pre-2022 era, leading to a mortgage shock that is still filtering through the economy. We are seeing a trend where homeowners are opting for longer-term fixed rates to avoid volatility, but this is limiting the liquidity in the secondary housing market. The current policy is a tightrope walk. Cutting rates too early risks a resurgence of inflation, while keeping them high for too long could stifle the GDP growth that the UK desperately needs to recover its international competitiveness. Looking at the latest Consumer Price Index data for June 2026, we see a divergence between headline inflation and core inflation. While energy prices have largely stabilized due to diversified supply chains, the cost of services, including healthcare, education, and hospitality, continues to rise. This is known as service-led inflation, driven largely by wage growth in the public and private sectors. For the average consumer, this means that while the price of petrol might be steady, the cost of a meal out or a dental appointment is still climbing. This disparity creates a psychological burden on the public, where the perceived cost of living remains high even when official statistics suggest a slowdown in the rate of increase. The financial update is incomplete without addressing the housing market. In 2026, the gap between average earnings and property prices has reached a historic peak. In cities like London, Manchester, and Birmingham, rental inflation is outpacing wage growth by a significant margin. This has led to a surge in generation rent, where professionals in their 30s and 40s are unable to enter the property market. The social impact is clear: a decrease in social mobility and an increase in multi-generational living arrangements. We are seeing a rise in hidden homelessness, where individuals are technically housed but living in precarious, overcrowded conditions, which directly correlates with a decline in overall mental health and community stability. The UK labour market is currently experiencing a strange paradox. We have high vacancy rates in specialised sectors, particularly in green energy and healthcare, yet we see a rise in underemployment in traditional retail and administrative roles due to AI integration. Real wage growth, when adjusted for inflation, has shown modest gains, but these are unevenly distributed. High-skilled workers are seeing salary increases that allow for discretionary spending, while low-income workers are struggling to keep up with the cost of basic necessities. This widening wealth gap is creating a fragmented economy, where the two-speed nature of the UK economy is becoming more evident in the divide between the southeast and the north of England. The social impact of the current financial climate is most visible in our public services. The NHS and local councils are operating under extreme fiscal constraints, with the government attempting to reduce the national debt-to-GDP ratio. Austerity-style pressures are returning. We are seeing longer waiting lists for elective surgeries and a reduction in local authority funding for libraries and youth centres. This creates a vicious cycle. As public services decline, those who can afford it move toward private alternatives, further deepening the social divide. The financial pressure on the state is not just a budgetary issue. It is a social crisis that affects the quality of life for millions who rely on the social safety net. From a macroeconomic perspective, the pound sterling's performance against the dollar and the euro continues to influence the UK's import costs. As a net importer of food and raw materials, Any dip in the pound's value immediately translates to higher prices at the checkout. In June 2026, the GBP has remained relatively stable, but volatility in global markets, particularly in East Asia and North America, continues to pose a risk. This instability affects small and medium-sized enterprises, SMEs, that rely on international trade, forcing many to hedge their currency risks or reduce their import volumes, which in turn limits the variety of goods available to the British consumer. Despite the challenges, there is a silver lining in the UK's transition to a net-zero economy. Investment in offshore wind, hydrogen power, and electric vehicle infrastructure is creating a new industrial base. These green jobs are providing a lifeline for former industrial heartlands, bringing investment into areas that have suffered from decades of disinvestment. However, the transition is expensive. The financial burden of retrofitting millions of older British homes for energy efficiency is immense. Without significant government subsidies or low-interest green loans, the cost of the transition could fall on the homeowner, potentially creating a new form of energy poverty for those unable to afford the upgrades. To summarize today's update, the UK is in a period of fragile stabilization. While the peak of the inflation crisis has passed, the social scars, high rents, strained public services, and wealth inequality remain. The key takeaway for the viewer is the importance of financial resilience. Diversifying income streams, understanding the nuances of current interest rate trends, and staying informed on fiscal policy are essential for navigating this era. The economic data tells one story of recovery, but the social reality tells a story of struggle. Balancing these two is the primary challenge for the UK's leadership moving into the second half of 2026. Stay informed, plan your finances carefully, and keep a close eye on the Bank of England's next move.